Okay, so let's talk about AI stocks. They are absolutely on fire right now. I mean, the valuations are just through the roof. But here's the big question. Is this a real sustainable boom, or are we all just watching another massive bubble inflate, waiting to pop? Let's dive in and try to figure it out.
And really, that's the question on everyone's mind, right? Are we living through another dot-com bubble? I mean, you can feel it. The excitement, the insane valuations, it all feels so familiar. But is this really just a rerun of the 2000 crash?
To get to the bottom of this, we're going to break it down into 4 key areas. First, we'll compare today with the dot-com bubble. Then, we'll look at what's really a tale of 2 different AI markets. After that, we'll try to solve this circular investment puzzle. And finally, we'll ask, what's the real risk here?
All right, let's jump right in. We're going to put 2025 right up against the dot-com bubble. And you know, while history might seem like it's rhyming, it's definitely not repeating. The hype feels the same, but the fundamentals, totally different story.
So check this out. The real difference is who's driving this thing and where the money is coming from. Back in 2000, it was all about speculation, right? Throwing debt and IPO money at unprofitable startups with unproven ideas. Fast forward to today. This AI boom is being led by absolute giants, some of the most profitable companies the world has ever seen, and they're funding it with their own cash flow, based on real, immediate customer demand.
And if you look at the actual numbers here, it gets even clearer. Yeah, you might notice that the market is even more concentrated in a few top companies today, which seems kind of scary. But look at that last row, the primary funding source. That's the game changer. Back then, speculative debt. Today, cold, hard cash from operations. It's just a much, much more solid foundation.
And that's really the biggest difference, right? The companies leading the charge today have what you'd call fortress balance sheets. We're not talking about some speculative startup that might just vanish. These are giants. This isn't a gamble on whether they'll survive. It's a bet on how huge their next chapter is going to be.
Okay, so it's not a dot-com bubble, but it gets a little more complicated because the AI market isn't just one thing. It's actually split in 2. You've got the grounded companies, and then you've got the ones that seem totally detached from reality. So here's how you have to think about it. The AI market has basically split into 2 camps. First, you have the fundamental-driven companies. Their valuations are insane, yeah, but they're backed up by explosive, real-world earnings. Then, you have the narrative-driven companies. Their valuations are also insane, but they're completely detached from what the company is actually earning today. It's all based on a story about the future.
And the perfect example of this fundamental-driven side is NVIDIA. I mean, look at this quote. The valuation isn't detached from reality. The reality itself is so extreme it just looks like a bubble. It's a fantastic way to put it. And here's why. 93%. That's their data center revenue growth, year over year. That's the engine of this whole thing. The financial results are so insane, so extreme, that they're actually justifying the wild stock price. It's not a bubble when the earnings are growing even faster than the stock.
Okay, so that's one side. Now let's flip the coin and look at a narrative-driven company. And the poster child for this is Tesla. This is where the valuation seems completely detached. A speculative bubble where the numbers are in direct contradiction with what's actually happening in the business. Just look at this, a price-to-earnings ratio of around 297. What that means is people are willing to pay an incredible premium for the company's stock based on, well, a story about the future. And they're doing this even while the core auto business revenue actually declined. The valuation and the reality are just worlds apart.
This chart just says it all, doesn't it? On one side, you have this massive trillion-dollar-plus valuation. On the other, you have revenue growth that's actually negative. It's a huge disconnect. The market is basically saying, we don't care about your car business. It's valuing Tesla like an AI company that hasn't made a dime yet, betting the entire farm on a future that may or may not happen.
Okay, this brings us to something that has a lot of people worried, and for good reason. It's this puzzle of circular investments. Is it a brilliant strategic move, or is it just a house of cards waiting to fall? Because on the surface, it looks a lot like the shady stuff we saw back in 1999.
So here's the big question people are asking. Are these AI giants just financing their own customers to create fake demand? Are they just pushing money out the door so it can come right back in as revenue? It's a serious accusation.
Let's just walk through how one of these deals supposedly works. Take NVIDIA and OpenAI, for example. Step 1, NVIDIA pours, say, up to $100 billion into OpenAI. Step 2,
OpenAI takes that money and uses it to build out massive data centers. And step 3, what do they fill those data centers with? You guessed it, NVIDIA chips. The money goes out, and then it comes right back. So, is this legit?
Well, it all comes down to why they're doing it. The motivation is completely different. Back in the dot-com days, the motive was to fake revenue because real customer demand just wasn't there. But today, the motive is to strategically secure a supply chain where the demand is absolutely real, it's massive, and it completely outstrips the available supply. So you see, this isn't about faking demand at all. This is a supply chain war. It's a fight to secure the most scarce, most valuable resource on the planet right now, AI chips. For a company like OpenAI, this is a strategic move to guarantee they get the computing power they need to exist. It's not a trick, it's a survival tactic.
Okay, so if it's not a repeat of the dot-com bubble, what's the real risk? What's the thing that could actually bring this whole party to a halt? Well, it all comes down to one big question, the return on investment.
Look at this number, $400 billion. That's how much Microsoft, Google, Amazon, and Meta are expected to spend on AI infrastructure this year alone. That is a mind-boggling amount of money. We are witnessing one of the biggest capital investment cycles in human history. And here's the thing. The risk isn't that these companies are going to go bankrupt. They won't. They're way too profitable for that. The real risk is that all these massive investments just don't pay off. It's not about them surviving. It's about whether they'll get a return on all this cash they're spending.
So this is the real risk. The trigger for a downturn isn't going to be a bad earnings report from NVIDIA. The trigger will be when its customers, the ones spending that $400 billion, can't turn that investment into profitable AI applications. Because if they can't make money from AI, they're going to stop spending money on AI. It's that simple.
So here's your key takeaway from all of this. You can't just think of AI as one big, monolithic thing. It's not. To really understand the market, you have to break it down. You've got the infrastructure sellers, the NVIDIAs of the world, you've got the platform monetizers, like Microsoft and Amazon, and then you have the narrative-driven bets, like Tesla, where it's all about the story.
Which really leaves us with this final question. The AI gold rush is definitely on. That's not up for debate. The question isn't whether there's gold out there. The real question is, when all the digging is done, who is actually going to profit? Who's going to be left holding the gold?